So just to kick us off, I mean, climate capital is a very big topic. It's critical that we collectively find ways to crowd in participation from all participants right across the financial spectrum, and certainly impact capital has a meaningful role to play here. While the Paris Agreement commits us to limiting warming to well below 2 degrees, our current trajectory has us going into overshoot. Presently we're warming at around 0.2 degrees per decade. So it's looking likely that, we're going to hit that 1.5 degree outcome by at least the mid 2030s, if not 2040s. And so certainly from a finance perspective, what happens in the next decade is critical from a long run perspective. As it stands, climate finance is reaching and has reached record levels, starting at around 2013 at 340 billion per annum. We're now up to roughly around 600 billion per annum directed towards climate finance. And while this is a relatively impressive number, it still falls well short of what's needed to get us to below at least 2 degrees, or if not 1.5 degree scenario. So estimates of the current investments required to achieve this low carbon transition, range from around 1.6 trillion to 3.8 trillion annually out to 2050. And that's just on the supply side for energy systems investments alone. It's to say nothing of the other aspects of climate finance. So, there certainly is a need for the world's 386 or 390 odd trillion global financial system to undergo a tectonic shift towards what some are calling the finance sector triple jump. This idea of scaling up spending, really pushing more capital intentionally into the space, starting to think very critically about how to spend differently. How do we actually think about directing capital towards sunset industries? What does divestment look like north of the equator versus south of the equator, given the just transition discussions? How do we redirect that capital towards things like renewable energy and regenerative land use? And then lastly, and critically, in this triple sector finance, triple jump, for the finance sector, is this idea of linking intentionally finance towards development impact outcomes. So just to sort of get a sense of that, in the emerging markets context, some roughly 2/3 of the global spend on energy over the next 2 decades is going to have to be in low income countries, and so how do we scale and direct that capital to simultaneously solve for both biophysical and social resilience outcomes? So look, I mean, what I painted is what sounds like a pretty challenging picture, but there's also opportunity here, and I think for people in the finance sector, that's what gets us out of bed every morning. So some recent analysis done by the IFC, just looking at the NDCs of 21 emerging market economies, shows that there's a roughly $30 trillion climate investment opportunity in emerging markets across 6 urban sectors in areas such as green buildings, public sector infrastructure, electric vehicles, water management, renewable energy, and waste handling. So certainly there's opportunity. So what's clear is we need to find new ways to work together to tackle this collective problem. It's going to require really coordinated commitments from central banks, DFIs, insurers, fund managers, private sector, banks, and even rating agencies. And so, with this as a kind of contextual kickoff, what I'm going to do is kick off with a round of questions. And perhaps, Marc, we could start with you. And then we'll go to you, Itske, and then Marc, and then finally we'll close off with you, Vuyo. But the question really is this, is given where you're sitting and your particular role in the investment ecosystem, and given this particular moment we find ourselves in this kind of, during post-COVID, I'm not quite sure exactly where we are, but given this COVID moment and the scale of fiscal stimulus that's been putting into the global economy, how does this, if anything, change the outlook for climate capital and climate finance?
Well, first, I think it's a bit too early to say post-COVID. Definitely the numbers and things we're seeing in Europe at the moment are very worrying still. But the amazing thing for us, and obviously it's been a dreadful time for so many businesses, for so many people individually in what they've had to go through. But it has been a moment of introspection for many people in their personal lives about what they want to see, what they think is valuable to them. When you can no longer go out on the weekend and go shopping and do all the things you used to do, you do have to start thinking about really what is important to you, what matters. And we've seen that happening on a personal level. We've seen that come through in inequality conversations, particularly around Black Lives Matter. And we've seen it also in business. And we've seen a lot of businesses. We've been inundated actually around the work that we've been doing with particularly some of the bigger FTSE and some of the bigger Global 500 companies coming to us because they realize that they are in a situation now where they need, we thought we lived in a world where actually everything was stable. No matter what we heard on the news every night about climate and things, everything seemed stable. And actually, this has been a big shock to the system. And even if people aren't necessarily relating this all back to the impacts upon nature and inequality, even if that isn't their driver, the idea of understanding the risk that you face and getting a better handle on that has been key. And we've seen lots of businesses coming to us and saying, actually, we want to have a better way of understanding our relationship with nature, with people, with the other capitals, with natural capital, social capital, human capital, produced capital, manufactured intellectual. How do we actually really understand that in a strategic way so that when this comes back round again, because we know this isn't going to be the only case of a virus like this, when this comes back round again, they'll be in a better position. If that's the starting point for a conversation, that opens up so many different ways of thinking about this. And that's why I think there's been a real increase in people being interested in this area over the last few months, particularly. I mean, we've got new businesses from a range of different sectors. In fact, we're just at this very moment in time launching some work around the food sector with businesses, particularly in Mexico, in Brazil, in China, in India, Indonesia, Thailand, Malaysia, looking at businesses around that food sector and how this is going to affect them. The investment is needed. We've started seeing some of that flowing. And organizations like Olam, who have been spending a lot of time focusing on these risks over the last couple of years, carrying out assessments, understanding how the financial capital needs to flow through to understand natural capital, social, human capital. They've started getting preferential finance coming through, and we've seen that come through DBS Bank, BNP Paribas, and others. And if you'd have asked me a couple of years ago, would we see that happening? I would have said, oh, I'd love to see it, but it won't happen. It's happening now. We're seeing the money flowing to where people have a better understanding of the risk. A lot further to go, but I think there's definitely seeds at the moment and shoots, which are very promising.
Yeah, thanks, Mark. I think what you're pointing at is this, you know, COVID comes as an exogenous system shock. And I think it sort of wakes the world up to the fact that, you know, the finance sector is not insulated from what happens in nature and society. So Itske, from where you're sitting, you know, given your particular role, and you know, how's COVID changed the outlook for climate capital? I think you might be on mute.
Thank you. What Marc just said also very much resonates with us and with me. And we see that indeed private capital is becoming more and more sustainable and more available. We're talking, we are doing impact investing already for several decades, but we see an enormous increase indeed. On the one hand, indeed, on the topic, and really people seeing also that systematic change and wanting to contribute to that and investing in that. But also, I must say, also not in the least also because of over liquidity, searching for yield. And we must also realize that. And it's a thing that to also calculate with. What I'd like to point out is also on the public capital side. And we also see a change in landscape there, where on the one hand, due to COVID, public spending to fight the effects of COVID has jumped dramatically. And that is a major shift also comparing to pre-COVID, where austerity, especially also in the Netherlands, was really the main topic, I would say. And we also see a willingness to invest in a climate transition recovery, at least if you look at the Green Deal in Europe, etc., and plans in France. But what we might see also is a crowding out of climate initiatives in favor of social goals, social goals. And what we also see is that still more than half of the public support for energy still goes to fossils. And what we see is that although there is an increasing interest in really investing climate transition recovery, what we also see is that there's still an inclination to really finance the old school recovery, economic recovery, and I think that's throwing good money after bad money. So especially on the public capital, there are still some challenges to go, I would say.
Yeah, thanks for that, Itske. I mean, just anecdotally, we recently conducted some analysis across the retail investment market here in South Africa, and we've seen a major spike in the local retail appetite to put capital to work in a more sustainable way. So, Vuyo, coming across to you, I mean, how does this COVID moment change the outlook for climate capital as far as you see it on the African continent? Oh, Vuyo, you still? I think you might be on mute.
Okay, there we go. I was just saying that for us, it's a two-pronged impact. I think the first impact is the impact on local African capital. I think, as you've just mentioned around kind of retail investors and their appetite, we've seen a big shift in focus to a focus on kind of resilience and climate resilience funding, and a big focus on projects of that nature from local capital. I think similarly, looking at what international investors are looking for, we've seen obviously the theme of building back better has been a key theme, particularly in Europe, where there's this big focus on the green economy recovery. I think where there is potentially a risk is that there could be almost a one-size-fits-all approach in terms of, the types of areas where this capital can be applied, which could mean that there's actually a shortage or lack of capital in other areas that might be required for development on an ongoing basis. So I think our focus is probably on being more parochial, where climate resilience opportunities are available is an area of key focus. But at the same time, we're also aware that the old economy recovery aspects that need to be dealt with in the medium term. So I suppose you could call us a bit more pragmatic in terms of where we invest, but our bias is definitely towards green economy and climate resilient investments.
Yeah, thanks, Vuyo. I mean, you're making a good point in the sense that, what the transition and recovery looks like in an emerging market economy is certainly not the same as what it might look like in a more developed economy. Marc, let's come to you and get your views. And, how's COVID changing the outlook for climate capital from where you're sitting?
Yeah, John, I think it's just brought forward demand considerably. I mean, across three sectors. First, within the government sector, if what should we expect if we just spend trillions of dollars to bail out an economy? Is it fair to assume there may be some fiscal conditionality? And I think within the government sector, that's going to be internationally and on a nation by nation basis be increasingly part of the policy. Fiscal conditionality, I think, is brought forward by COVID substantially, and we're seeing that in climate plans around the world. I think within the kind of corporate responsibility category, we're seeing companies being rewarded that are more sensitive to climate and ESG goals, and I think we're going to see multiples diverge in companies that are constructive and taking these goals seriously will be rewarded, and those that are not will be penalized. And I view that as a net positive, and I think COVID brings that forward. I think within private and investor capital, the data speaks for itself. You know, the demand for climate sensitive portfolio allocations will continue to rise. To put some meat on the bone, as of mid-June, just ESG funds themselves comprise greater than 30% of all flow into global passive equity funds. That's an astounding number. That's a huge number. And I think that trend will continue. So I think COVID has brought all that forward, and the pattern recognition of the past is, difficult scenarios bring forward structural change. So again, Sir Ronald speaks about gap accounting in 1929 as a consequence of the Depression. So we've just had, and we're having, environmental and climate tragedies happen to us every day. And I think we should be part of, where all of us on this panel are trying to promoting this, and ultimately COVID, I think, brings this forward and accelerates it. So I don't expect that to change anytime soon. And I think that's my kind of simple heuristic of how COVID is accelerating everything. And it's a bit of a silver lining amidst the tragedy, but we are seeing it in the flows of capital and capital allocation, and that's not going to stop anytime soon.
The unmute button is sometimes quite hard to find. So thinking about the scale of fiscal stimulus that's going into the economy, and kind of, I wanted to push you each in terms of from where you're sitting, what role, I guess, can you play in your jurisdiction, or what are your thoughts around, how do we actually really start driving a kind of impact-led recovery? So Marc, you mentioned it earlier, this kind of conditionality around, how do we bring capital to bear that actually is intentional around its impact from a climate perspective? And I want to kind of touch on something that was mentioned earlier in terms of potential, climate, the need to sort of address social issues, potentially clearing out, climate capital. So my question here is, how do we direct capital to sort of really drive an impact-led recovery? And, Itske, I'm kind of curious to maybe start with you and then go to you, Marc, for some initial comments.
Yeah, well, I think we need to move, we need a paradigm shift in our focus on economy, to really focus and to continuously, in my daily life, we focus on finance the change. But at the same time, we also have to change finance, change the financial world. And we continuously tell about this paradigm shift that we really need. The paradigm shift from fossil to renewable, in the food sector from meat-based to plant-based, from efficient markets to sufficient markets, from unequal to inclusive. So really, and there's a lot more, from optimized economic systems to resilient economic systems. So we really try to continuously tell about this paradigm shift that we need. At the same time, for example, our organization is also involved in the Netherlands and also in Germany and in Spain with the governments, the Ministry of Finance, to really set up a system to calculate the carbon emissions, the carbon footprint of the financial sector, and set targets and really live up to those targets to decrease the exposure to carbon in the financial sector. So very concretely trying to decrease that exposure. But what is needed is this shift in economy. We need policy, we need businesses, and we need this orientation of finance to change. And what really helps are initiative also by governments, setting out where are we going, in what direction in a given country, and really to support that steps. But we'll get to that later on, also on the question on how do we scale climate finance. But also what do we need? Basically, I would say that sustainable investments have now turned out to be, and generally performing better than non-sustainable counterparts. And basically yield, and a good yield, and a resilient yield, not so volatile, but resilient, actually is the best accelerator.
Yeah. Thanks for that. So Marc, from your perspective?
Having two Marcs on the panel is always a challenge. I used to have a meeting once a week with 3 other Marcs. It was always great fun because people would knock on the door and shout Marc and then run away. There's a lot of us around. So I completely agree. And I think this thing that we were just talking about there about the needing a systems-based approach to this is really important. We've been here before where you'll find financial institutions that want to invest but just can't find the projects to do it. You'll have businesses and others that say they need the investment but they can't get it. Governments trying to work it out about where to put the policy angle into it. And actually each part of that, every single one of them thinks they've got the solution. Every single one of them thinks everyone else is the problem. And that can't be the case. We've got to find a connected way of doing this. There's a couple of things we need to do that. I mean, there are governments already that have come out very clearly after COVID, like the Scottish government in the last couple of days here in the UK, saying that their recovery is going to be based around the natural capital that they've got. We've got to be able, though, to measure and value that properly in a standardized way. And I think that's where the challenges come. We've been doing this at a government level since the 1970s. There's been ways to start looking at accounts for what we've got in the way of nature. But we now need to standardize that. We now need to move that from a possibility of doing it, a could, into a should, and then into a must. And there is a trajectory over this next 5 to 10 year period, particularly in the European Parliament, which has been a leader in this, to start trying to mandate and make sure it's very clear what is green, what isn't green, the taxonomy that I'm sure a lot of you have heard of. There's also the Dutch government, we're a Dutch entity as well, so hello. But the Dutch government recently, I think it was yesterday, have just announced that they're going to be backing and supporting the Task Force for Nature financial disclosure. So broadening the work that's been going on the climate disclosure into nature as well. And I think that understanding that actually nature, climate, inequality are all interconnected is really important here as well. We've done this before as well, I would suggest. We've invested in one area and then we've seen fallout in other areas because we weren't aware of the system. So the fundamental thing for me here is understanding how the interconnections between it. And to be honest, that's where the concept of a capital, be it financial capital, whatever, really helps us to make sense of that. Because when we think of capital, it's something we invest in that has multiple returns. So if we can measure and value those in a consistent way, which is the work that the Natural Capital Protocol and other things that the community that we're involved with has been doing, that consistency, if we can then get that into the way that we work and the language that finance sector uses, that business use, that governments use is consistent across that, then we'll start seeing the traction. It won't just be shoots. We'll actually start to see this to be consistent in the way it's being applied.
Yeah, thanks for that. So what's interesting from where I'm sitting in South Africa, as recently as the last sort of 3 months, our National Treasury started discussion on the development of green economy taxonomy. There's a discussion paper. So certainly I get a sense that, this idea of directing capital towards kind of long-term resilience, there's political appetite. I think, certainly from a political perspective, if you want to capture the sort of youth vote, this is somewhere where you need to be thinking about it. But
and definitely in Africa as well. We've just run an African forum more recently, and the work that's going on in Africa with the resources and things they've got there, there's a massive opportunity to leapfrog. And Africa is often the place that's left out of a lot of these conversations. We go to Asia, there's an awful lot going on in the Americas. There's an awful lot going on in Africa at the moment that we've seen, in the Green Economy Coalition has been leading a lot of that with us, and various other things. Exciting times there.
So, I mean, Vuyo, you're an African-based infrastructure investment manager. I mean, give us a pragmatic view from the ground up. I mean, what's really needed to support this kind of leapfrog, right across kind of fossil fuel industries to the green sort of utopia that we're aiming for here?
Yeah, I mean, talking about Africa specifically, I mean, the countries on the continent are so different. You know, in the north, you have South Africa, for instance, which has huge coal reserves and big vested interests in the coal sector, and you know, the lots of renewable potential, for instance. So in shifting from coal to renewables, what do we do about you know, the communities who work in the coal mining regions, for instance? And I know a lot of the research, and especially as seen in the likes of India and China, speaks to focusing on manufacturing in the renewable space, for instance. But if you don't have the industrial capacity to take advantage of manufacturing in that sector to begin with, you know, it's very hard to mitigate the impact on those communities. So I think this is what policymakers, for instance, in the likes of South Africa and other similar countries which are very carbon heavy, are grappling with, is how do you make the transition, but at the same time offset the immediate and medium term effects on communities who currently rely on carbon heavy industries. So I think, you know, ourselves as investors who are very green leaning, I mean, we're the largest investor in renewables in South Africa, trying to come up with solutions on how the transition becomes a just one, how we replace jobs in the Mpumalanga province, for instance, with green jobs into the future. In East Africa, for instance, you know, the question is less one of power or energy for industrialization and more about access. So in those markets, you know, we have a partnership with a company called B-Box, where we do solar home systems in that part of the world, and we've been able to reach 100,000 households thus far, and the impact is massive. And you're not replacing coal power with renewables. What you're actually doing is replacing potentially biomass in some instances with a completely clean and technology that completely transforms the lives of the people who use it. So, you know, these are our focus areas where we can make a significant impact. But you know, while we're making this impact, we're pragmatic and we try to understand, you know, the trade-offs between the current and the future. And the truth is, I think it's all about you know, timeline. I think you know, it's all about replacement versus initiation. When you're replacing things, I think your timelines can be shorter, but where you're trying to kind of initiate things that haven't been there in the past, it's a much more long-term outlook. And the question is whether, you know, the investment capital that's looking to invest in these areas is patient enough to see through, you know, that migration from nothing to, you know, a greener and more resilient economy.
Thanks for that, Vuyo. Marc, maybe coming to you from a US perspective. I mean, how you're seeing it in terms of scaling capital to be sort of more impact-led around the climate finance story?
Yeah, and a lot of what Vuyo said kind of is relevant for North America too. But I think first, candidly, just taking a step back, we need to, I don't think there's really a definition for what climate investing is now. And that's, that's a task that needs to be accomplished, you know, for investors to feel comfortable allocating. You know, within ESGs, there's been some slight link to the SDGs. And I think that's been helpful. So I think in terms of answering the questions, what's needed to drive on a global level, there spending some time on defining what climate investing in is quite relevant. I mean, I have a bias, and at Rise, there's a bias to define it as breaking the trend between positive GDP and increasing CO2, CH4, and kind of black carbon emissions, right? That, you know, there's a nearly, you know, 90 R squared, very high correlation between, you know, CO2 emissions and GDP growth. And so, you know, I think spending time there is quite relevant. One, two is, and this is where Vuyo's comments really resonated, is, you know, owning that climate investing, and this may be slightly controversial, is one part about transparency, but also another essential part is about transition. And working with companies in transition, I think, is really important. And that can be difficult, but important. But Jon, specifically in North America, I think the US government has been quite helpful in defining areas of focus. So really understanding low carbon fuel standards, the renewable fuel standards, the RIN market, the renewable identification numbers market is a great way to focus climate investors. And I would strongly encourage people to look there, because it's going to be a burgeoning market. It's the amount of growth is material. You know, at a Rise level, we have companies like Clear Result, which encourages responsible consumption technologies for energy assets. You know, I think within the North American investable universe, looking at those standards as guidance markers is a good way to allocate resources, you know, thoughtfully and considerably, and hopefully profitably. So using the standards framework that the U.S. government has provided is a lens to, I think, you know, efficiently really go on the ground and allocate dollars.
So I've got a couple of questions coming through here, and I'm going to try and weave some of these into the next round of questions. And you know, Marc, Gough, maybe we'll start with you, but the question here is, you know, within the climate theme, you know, where you're seeing the most compelling projects, both from an impact and a financial return perspective. And then related to that, you know, how does climate finance, and sort of being respectful of the broad definition here, how does it actually solve for other major social or environmental risks?
I'm very aware that we're all being quite positive here as well. And
yeah.
If it was all as good as we're all saying, then we would have solved all of this already.
Sure.
So I mean, where are the projects? There are some projects out there proving that they're the right ones. There's an organization called CPIC, which has been trying to get some real definitions behind, proper definitions behind what is good, what is bad. It's an international organization. There's also a community of practice, which is launching a pledge for biodiversity on the 25th of September coming up this year as well. There's lots of financial institutions involved in that are finding connections with those projects on the ground. So we've got the good stories. We can all pick out a few of those. I think it's definitely, though, not mainstream, and that's because we're not standardizing it. We're not getting to the point where we can actually clearly define what is good and what is bad, and we're not using valuation to do that. What we're mainly doing is measurements. So what we're doing is we're taking a quantity of something. We're saying it's 1,000 trees there, 1,000 trees there. We're not saying what benefit they're actually creating for the local community, and that's the way we connect it in to people, because it's got to be about value to who. And that's the question that we should be asking here. Not just the value to my business, because of course we all want to make more money. We want to make sure the money is working well for us. But where is that value actually being driven? And if we can start defining that better in a standardized way, then we don't have to force together social, environment, and everything. It comes together very organically in the way we do it. So to my mind, there is still an awful long way to go. Some leaders in there, but there are not enough projects out there that are following a standardized way at the moment.
Yeah, it's good from where you're sitting. I mean, just thinking about sort of investment opportunities, where you're seeing those and which technologies and which regions. And then, yeah, just a thought on, you know, how does climate finance also solve for some of the, or balance or contribute to long-term environmental and social resilience?
Yeah, well, we're active both in Europe and in emerging markets. we see compelling projects both in Europe and in emerging markets. What I see as an interesting example is that you see renewable energy projects on the one hand becoming bigger. I think of the big offshore wind farms, but at the same time also more decentralized and much more citizen initiatives involved. And I think it's very important to support and those decentralized smaller projects and be involved there, because they come up bottom up, and I think in the end they may grow bigger in total, maybe even than the huge projects. So a real focus there. And I think a nice example also in the climate agreement in the Netherlands that says that renewable energy projects, at least 50% should be owned by local citizens in the area of those projects. So it's really prescribing, and that really also helps to get that involvement much more greater. With emerging markets, I would also like, in emerging markets, we also support several projects. And what I find very interesting there is that we see that in very many cases, the local cost of energy, so the price per kilowatt hour, is generally lower if it's produced by renewable energy sources than from fossil fuel sources. And that meaning that the PPAs, the power purchase agreements that are being signed, are attractive, and that in a sense is again yield talks. So it is from that point of view, it's a low cost price, so that is interesting. And it's in a way a kind of a natural risk mitigant, because the electricity that is produced is attractive. And what I find, yes.
Can I pause you there for a second? I'm just getting a message here from the moderator telling us that we are actually running out of time rapidly.
Really?
So
yes, I'm afraid we need to wrap up.
I'm going to quickly ask Vuyo to chip in for one comment, and then Marc as well, and then see if we can squeeze in a quick round of closing comments from each of you.
I'm afraid we need to close very promptly, so be very brief.
So Vuyo, if you wouldn't mind leading us with maybe a closing thought.
From my side.
Let's try Vuyo to start. You're on mute, Vuyo.
Okay, thanks, Jon. Yeah, I think maybe the best way to close is to also answer the question on the webinar chat around where we see the most compelling themes. And I think renewables are certainly an area where we see lots of opportunity and impact. And in keeping with what Itske was describing earlier, I think, for example, the projects in South Africa require significant amounts of community ownership in the first instance. And over and above that, there's a requirement for specific amounts to be spent on enterprise development in the communities in which those projects are based. In addition to enterprise development, it's also about kind of CSI spending from those projects in the actual community, so that there's community support for those projects. And I think that that combination of climate impact as well as community impact, and a lot of the projects are around gender diversity and economic development, and definitely the area where I see the most benefits in my part of the world.
Yeah, thank you, Vuyo. Marc, we're going to give you the last closing word from the US.
Sorry, we really do have to finish because we have others waiting.
Yeah. So
I'm very sorry.
2-second closing from you, Marc, from the US, and we'll end it there.
Yeah, no, this has been a terrific panel. Look, let's just quote Churchill: "Don't let a good crisis go to waste." And I think COVID should catalyze us and motivate us in this moment we have to work even harder, and the opportunities in capital are greater. So even though we're inspired by difficult situations, let's focus and work harder, because there is demand here for these assets, and we are in this moment where we should converge the demand with the relevance and matter at hand. So I'm quite optimistic, but it's just going to take a lot of work, and I know we're short on time. But Jon and Marc and Vuyo and Itske. It's a real privilege to be on the panel with you guys.
Yeah, thank you everyone, and apologies for running over late, and appreciate you all being online with us.